So this is problem 1, allocations requiring substantial economic effect. We're focusing on section 704B and the regulations with respect to that item. This is meant to be an introductory problem. There's another problem that's a little bit more advanced, goes in more depth. This is the introductory problem. So Lemon and Lime are calendar year individuals. They formed Citrus Courtesy Cart General Partnership 3 years ago to engage in luxury limousine golf cart service business to drive people around downtown events. They each contributed $100 cash. Their interests under the partnership agreement are as follows. So this is how they split profits and losses and also their capital percentages. Okay? As you can see, not everything is 50-50. That's the important thing to note. Not everything is 50-50. Now, capital accounts, including deficit restoration obligations, will be followed in making all distributions, both current and liquidating. Capital accounts will also be maintained according to Reg 1.704-1B2 little IV. During the first year of operations, Citrus Courtesy Cart had the following income and losses. So we got year 1, 2, and 3. So we got really 3 things we're going to focus on. First, how would Citrus Courtesy Cart allocate profits and losses for the first 3 years of operations? Next, if Citrus Courtesy Cart were to liquidate at the end, alternatively, of each of these first 3 years, who would receive what? And then what if, in June of year 3, when it looks as though Citrus Courtesy Cart will earn about $200, Lemon and Lime amend the partnership agreement to adjust their profit shares for year 3 only as follows. Sorry, that should be profit. Profit, my apologies, 30-70. Okay? The profit shares, put capital there, my apologies, 30-70. What effect might this have on your conclusions about the allocation of tax losses in years 1 and 2 and the allocation of bottom line income on year 3? So we're starting with, how would Citrus Courtesy Cart allocate profits and losses for the first 3 years of operations? Okay. It's really important to understand what kind of partnership this is. So we're told that Lemon and Lime, they formed a general partnership. That's very, very important. When you're talking about allocations in section 704B, the type of partnership involved is very important, especially when the problem leaves out a lot of information. Not all the details of the partnership agreement are given, because if they're not, as you know, in partnership law, entity law, if an agreement is silent, you go with the default rules. The default rules for partnerships, general partnerships, are that each partner has unlimited liability, unless there's something that says otherwise with respect to the restrictions. Okay? So both Lemon and Lime have unlimited liability here. Okay? Because we're not told anything otherwise. They each contribute $100 cash, and then we have their ownership percentages. So going through this problem, we're going to focus on the partners' book capital accounts. Because the idea in section 704B says, okay, we look at the partnership agreement. We will follow the partnership agreement unless the partnership agreement is silent, which it's not here, right? This partnership agreement provides information, or it fails substantial economic effect. So then the idea next is, well, how do we meet substantial economic effect? We're going to focus this problem on economic effect. We're going to assume in this problem that substantiality is met. So to have substantial economic effect, the regulations break down economic effect and substantiality. We're going to assume that substantiality is met. Substantiality deals with kind of like shifting of income when like one partner has like expiring NOLs or they're in different tax rates. Let's assume they're both in the same tax rate. There's no differences in tax rates. There's no special tax characteristics. So substantiality is fine. But economic effect is what we're dealing with. So the regs for an economic effect found in Reg 1.704-1, there's 2 tests. We always start with the basic test. Basic test is all or nothing. If you meet the basic test, then it applies, always. Economic effect is met. If you don't meet the basic test, you go to the alternate test. The alternate test, you can either meet it for that year or fail it the next year. But the basic test, again, where you start, it's either all or nothing. It's not, oh, some years it's good, some years it's bad. No. The basic test, you need 3 requirements. The first thing is that you maintain capital accounts in accordance with Reg 1.704-1B2 little IV. which we do. We're told in the problem that we maintain capital accounts in accordance with the regulations. So we maintain capital accounts. So we're good with that. So that means when we're keeping track of our books, we are following those regs which pretty much conform with GAAP accounting. Second, if the partnership liquidates, liquidation follows positive capital account balances. So it doesn't go by capital ratio or profits or loss ratio. It goes by positive capital account balance ratio. So whatever's left in the capital accounts at that point gets allocated to those owners that way, based on what's in the capital accounts. The third is that unlimited deficit restoration. So because they're both general partners, and we talked about that, right? They're both GPs, and there's nothing that says to the contrary, they are required to go unlimited. So that means that all three of these are met. Maintain capital accounts, liquidation, positive capital account balance. We're told that here. Capital accounts, including deficit restoration obligations, will be followed in making all distributions, both current and liquidating. So that's what that says right there. And then unlimited deficit restoration, right? We even talk about deficit restoration obligations. We meet all three. So that means that however they allocate profits and losses are going to be respected. So the next thing to do is to just go through the book capital accounts for each year. Just to go through. They're going to be respected because we meet all three. And again, substantiality, we're going to assume in this problem, is not an issue because there's no differences in rates. But let's just go through the book capital account balances. So we've got lemon, we've got lime. They both start off initially, right? They contribute. This is book because tax needs to match book with respect to distributions. The initial amount, we're told, they each contribute $100 cash. Okay. So after year one, we're told there's a $100 loss. That's going to be allocated with respect to losses. Lemon gets 30 of that loss and lime gets 70. So we're going to subtract 30, subtract 70. Year two, we're going to have another $100 loss. So again, minus 30, minus 70. And then in year three, we've got $200 of income. That's going to be allocated 60, 40. So plus year three, I should say, right? Because now we have income. We've got 60, right? Because we got 120, right? 60% of 200 is 120, and then 40% of 200 is 80. So if we calculate their ending capital accounts as of the end of year three, that's going to be 160 for lemon, positive 160, and 40 for lime. So the idea is that if the business liquidated at the end of that year, that's what they would get. 160 and 40. Let's go to the next question. So again, it's going to be the capital accounts, or everything is respected under the basic test, so economic effect is met. Substantiality and economic effect are met, so that means that this allocation is good. Even though we have crazy allocations, right? They both contribute $100. Capital is 50-50 because they both contribute $100. But then profits and losses and those change. They're respected because we meet all three of the basic tests. So that's that first question complete, first part. If they liquidate at the end of each of the first 3 years, who receives what? So now what we're doing is we're basically going through each year. So there what I did was I went through each year individually, each year separately. Now what I want to do is I want to break this apart. I'm going to erase this and go back and redo it for each year. So those allocations still stay the same. They're still respected. But I just want to go through each year and do like a subtotal. So the end of year one, lemon gets 70, lime gets 30. So if the business liquidates and they sell for book value, unrealistically, lemon gets 70 of that, lime gets 30. That's basically what this is saying. Because of the partnership agreement, following that, right? Tax matches books, and that's how we've been allocating. It's respected. Remember, the most important thing when you think about 704, Section 704 is tax must match books. Tax must match books. Okay. Now we go year two. Year 2 is also a $100 loss. Again, we allocate 70/30. So now our balance at the end of year 2 is going to be lemon has 40, lime has -40. So if the partnership liquidates, at this point, they get nothing. They would pretty much sell off, or they would just dissolve. Lime would have to contribute $40, and lemon would get the $40 from lime, is basically what's happening. And that's how they've allocated their books. And that's how they want to allocate for tax too. That's fine. So economically, they're good. So the last one is year 3. Now we have income, right? So we're going to add, it's again 60% to lemon, 40% to lime. So 60% of 200 is 120. 40% of 200 is 80. So year 3, 160 and 40. So if they ended their business at that point, then lemon would get 160 and lime would get 40. With respect to your citations, with all this stuff, you'd want to find the basic test citation, which is found in Reg 1.704-1. You'd want to find that specific citation. The book Capital Accounting, that specifically, you're just going through the basic test and following this and what exactly each would get. There's nothing different that you're just following the capital accounts. So the last one we have to do is this third part of the question. What if in year 3, June of year 3, when it looks so, Citrus Courtesy Car will earn $200, lemon and lime then amend their agreement to adjust profits just for year 3 as follows. What effect might that have on your conclusions about the allocation of tax losses in year 1 and 2 and the allocation of bottom line income in year 3? So this changes the agreement, would lead to the following balances. So we would go back, I'm going to erase. Year 2 would still be -40, +40, right, for lemon and lime. Now we reallocate the $200. Now it's 30/70. So now 30%, right, that's what we're changing it to, of 200 is 60, and then 70% of 200 is 140. Now look what happens. Now lemon ends with 100 and lime ends with 100. So this raises an issue of substantiality. We talked about substantiality earlier, and I assume the rates are fine and all that stuff. But the idea is, if in year 1 and year 2, when there's losses, one of the partners gets to bear the benefit of the losses, but then ultimately, in the end, guess what? They come back to the same position. If there's some type of NOL or change in tax rates, different tax rates, then it could throw out this whole allocation. It could throw it all out. Now, as I said, we assumed that was not an issue. There wasn't any expiring NOLs that Lime had, right, where they were able to get that $40 loss in year 2, or there was no difference in tax rates. But if there was, it would throw out this entire thing. So you're saying, oh, well, what if you change it in year 3? You'd actually have to go back in year 1 and 2, and the IRS would reconstruct. They'd reconstruct the allocation. So you got to be careful. Substantiality deals exactly with that. There might be some issues where somebody is playing games or taking loss in early years, but then later they have income and it switches. So that's usually like the telltale time of a substantiality issue is when you have losses in one year and then you have income in another year and then ultimately you end up income like that type of situation here. But again, we're not going to assume we're going to assume there's no substantiality issues because there's no expiring NOLs or change in tax rates. So that's really the introduction problem, problem 1.